What if the American economy is on the brink of a catastrophe so massive it could dwarf every financial crisis you've ever seen? Not a whisper of it on your nightly news, not a headline in your feed, but it's happening. Right now, the titans of corporate America, names you trust, brands you love, are teetering on the edge of collapse. Tech giants, automakers, retailers, airlines. None are safe from the financial firestorm spreading silently across the U.S. debt spirals. Stock crashes, mass layoffs, and bankruptcies are unraveling the very foundation of the economy. We're exposing 30 major companies that could be the first to fall when the recession hits, revealing a truth that will change how you see the future. This is the story they don't want you to know. Let's dive in. The warning signs are everywhere, yet the mainstream narrative glosses over them. Behind the facade of corporate strength lies a grim reality. Decades of over-leveraging, reliance on cheap debt, and failure to adapt to shifting global dynamics have left America's largest companies vulnerable. Tariffs, supply chain disruptions, and a consumer base stretched thin by inflation are converging to create a perfect storm. The Federal Reserve's high interest rates, aimed at curbing inflation, are squeezing companies already burdened by massive debt loads. Meanwhile, global competitors, particularly from Asia, are outpacing U.S. firms with lower costs and faster innovation. This isn't just a cyclical downturn. It's a structural crisis exposing the fragility of industries once thought invincible. From Silicon Valley's tech darlings to Detroit's auto giants, the cracks are widening, and a recession could trigger a cascade of failures that reshapes the economic landscape. Tesla, the poster child of the electric vehicle revolution, is slamming into an economic wall. Deliveries have dropped 20% as consumers pull back on big purchases. Tariffs have jacked up battery costs by 25%, piling pressure on Tesla's $30 billion debt. Its valuation, over 100 times earnings, screams bubble, and the cracks are showing. Cybertruck recalls, rumors of Texas factory shutdowns, and looming EV subsidy cuts threaten to gut its lifeline. Layoffs have started, and insiders seem to know a storm is coming. If the recession deepens, Tesla's default risk could skyrocket, turning its meteoric rise into a cautionary tale. Boeing is in a nosedive. Safety scandals have shattered public trust, airlines are canceling orders, and travel demand is shrinking. The company has racked up $40 billion in losses from production delays and quality failures, with a $50 billion debt load looming large. A recession could push struggling airlines into bankruptcy, drying up Boeing's revenue. Supply chain disruptions and tariffs are stalling recovery, while the FAA tightens the screws. CEO resignation rumors and bailout talks behind closed doors signal a company on the edge of disaster. General Motors is facing a perfect storm. As the economy slows, consumers delay car purchases, with sales projected to drop 15 to 20%. GM's $120 billion debt is becoming unmanageable as its EV transition burns cash. Tariffs are squeezing truck profit margins, and legacy pension costs plus recent union strikes add fuel to the fire. Slashing executive bonuses is a glaring sign of internal panic. If consumer spending keeps sliding, GM's financial foundation could collapse, leaving one of America's auto giants in ruins. Ford is in the same sinking boat. High interest rates have made car loans unaffordable, tanking demand. Ford's EV division is hemorrhaging $5 billion a year, and its $100 billion debt is a growing liability. Rumors of Michigan factory closures and rising worker unrest are stoking fears. The market has taken notice. Ford stock is down 25% this year. A recession could push Ford into a full-blown crisis, threatening its century-long legacy. Apple, the tech juggernaut, is no longer untouchable. iPhone sales have fallen 15% in 2025, hit by tariffs and fierce competition from Chinese brands like Huawei and Xiaomi, whose advanced features and lower prices are capturing market share. A deeper recession could drive another 20% drop. Apple's $100 billion debt becomes a liability as global shipments decline and excess inventory forces profit-crushing discounts. App Store growth has stalled, and antitrust lawsuits in the US and EU are piling up, threatening the once invincible giant's dominance in a shifting market. Intel is fighting for its life. Despite $2.2 billion in CHIPS Act funding, The company has slashed 20,000 jobs as PC and server demand craters by 30%. Its stock is down 40%, and $50 billion in debt is harder to service with rising interest rates. Rivals like TSMC and AMD are stealing market share, and spin-off rumors for its foundry division hint at desperate measures to avoid bankruptcy. Intel's fall could signal a broader tech reckoning. NVIDIA, the AI chip king, is stumbling. Enterprise tech budgets are shrinking, with chip demand projected to drop 25%. The stock has plunged 30%, and tariffs on Asian manufacturing threaten to wipe out $100 billion in market value. High inventory levels and slowing data center investments could trigger mass layoffs. NVIDIA's reliance on AI hype, fueled by speculative investments, is proving to be a gamble that may not pay off in a recession. Carnival Cruises is sinking fast. Cruise vacations are a luxury, and luxuries vanish in downturns. Bookings are down 25% since the latest tariff wave, and Carnival's $30 billion pandemic-era debt is unmanageable as fuel prices spike. Occupancy rates have fallen below 80%, with canceled routes and ship sales signaling a shrinking operation. Health scares and global instability, including geopolitical tensions in key travel regions, are driving customers away, leaving Carnival's future in peril. Delta Airlines is grounded by a collapsing travel market. Business travel, a key revenue driver, is down 20 to 25%, and Delta's $25 billion debt is a growing burden. Tariff-driven ticket price hikes and labor disputes are worsening the situation, while technical outages have already cost $500 million. Merger rumors with other carriers suggest consolidation may be Delta's only path to survival in a recession-hit industry. Hertz is in a financial chokehold. Car rentals suffer when travel slows, and Hertz's pivot to EVs has backfired, leading to $1 billion in write-downs. Utilization rates have dropped below 70%, and $20 billion in debt is unsustainable as interest rates climb. A fire sale of its Tesla fleet signals a desperate scramble for cash, with bankruptcy looming as a real threat. Carvana is caught in the used car market's implosion. Auto loan affordability has plummeted, with repossessions up 20%. Carvana's $6 billion debt is toxic as credit tightens and loan delinquencies hit multi-year highs. Legal troubles over lending practices, including investigations into predatory loan terms, are mounting, signaling a business model on the verge of collapse. WeWork's post-bankruptcy struggles continue with $10 billion in lease liabilities. Remote work has slashed office occupancy to below 60%, and tech layoffs are emptying buildings. In a recession, WeWork's model, built on physical office spaces, could vanish entirely, leaving it as a relic of a bygone era. AMC Entertainment is on life support. Movie theater attendance is down 15%, box office revenue has dropped 25%, and $5 billion in debt looms large. Tariffs have spiked concession costs, and landlords are eyeing theater spaces for warehouses as AMC struggles to survive in a streaming-dominated world. Rivian, once an EV darling, is missing delivery targets by 30%. Consumer resistance to high-priced EVs is growing, and tariffs have raised component costs by 20%. Amazon's reduced orders are a blow, and with its stock down 50%, Rivian is pitching emergency funding to avoid collapse. Macy's is crumbling as brick-and-mortar retail dies. Over 100 stores are slated to close as inflation and online shopping erode traffic. With $5 billion in debt and excess inventory forcing fire sales, same-store sales dropped 5% in Q1. Amazon's dominance, with faster delivery and lower prices, is squeezing Macy's into irrelevance. Rite Aid is buckling under $500 million in opioid settlement costs and 1,000 store closures. Its $3 billion debt is unpayable as Walmart and Amazon's pharmacy push intensifies. Asset auctions signal a company on its last legs, with bankruptcy looming as a grim reality. Victoria's Secret is fading, with sales down 20% as consumer preferences shift toward inclusive, affordable brands. Tariffs have raised luxury goods costs by 10 to 15%, and its $1 billion debt is unmanageable. Down 35% this year, the stock reflects a brand struggling to stay relevant in a recession. Spirit Airlines is grounded by soaring fuel prices, up 20%, and $3 billion in debt from failed mergers. Load factors have dropped to 75%, and operational meltdowns have destroyed customer trust. Budget airlines don't survive recessions, and Spirit's future looks bleak. Peloton's high-end fitness model is collapsing as subscriptions drop 30%. Its $2 billion debt and $500 million annual losses are unsustainable. Inventory issues and cheaper competitors like Echelon are pushing Peloton into a tailspin, with an 8% churn rate signaling customer exodus. Unity Software, once a mobile gaming powerhouse, is faltering. Its stock is down 60% as developer budgets shrink and venture capital dries up. Facing $2 billion in losses, Unity's pricey licensing model is at risk in a recession. Buyout rumors by Epic Games suggest it may not survive alone. AMC Networks is bleeding $1 billion a year with $3 billion in debt. Cord-cutting and collapsing TV viewership are unraveling its model as streaming giants like Netflix and Disney dominate. Once iconic content is struggling to find an audience, pushing AMC toward the grave. Red Lobster's bankruptcy left it with $1 billion in debt and lease obligations. Over 100 locations have closed, and soaring seafood prices are deterring diners. With no buyers emerging, full liquidation looms as a real possibility. GameStop's meme stock days are over. Revenues have crashed 50% as digital downloads render physical game retail obsolete. Lease and debt obligations are mounting, and store closures are accelerating as landlords opt for empty spaces over unpaid rent. Jo-Ann Fabrics is buckling under $1 billion in debt as sales drop 20%. In a recession, consumers prioritize necessities over hobbies, leaving fabric stores in the dust. Jo-Ann's business model is fading as DIY projects take a back seat. Beyond Meat sales are down 25% as consumers choose cheaper real meat. High production costs, tariff-hit ingredients, and crushing debt are unsustainable. Retailers like Kroger are pulling products, and a $100 million inventory write-down signals deep trouble. Express is on life support with $300 million in debt and fading mall traffic. Tariffs have raised clothing costs by 15%, and younger shoppers are prioritizing experiences over fashion. Bankruptcy rumors are growing as Express struggles to compete with fast fashion giants like Shein. Big Lots faces rising import costs and shrinking consumer budgets, with tariffs making cheap goods pricier. Over 400 stores are at risk as cash flow dries up and unsold inventory piles up, threatening the discount chain's existence. Bed Bath & Beyond's post-bankruptcy revival is faltering. With fewer than 100 stores left, $200 million in quarterly losses, and 15% higher import costs from tariffs, the retailer is struggling. Consumers are delaying home purchases, signaling a short second life. 99 cents only is dying as inflation pushes prices above $1.50. Hundreds of stores have closed, with 6 straight quarters of negative cash flow. The dollar store model, once a staple, is now unsustainable in an inflationary economy. Snapchat is fading fast, with $4 billion in debt and a 25% drop in ad revenue forecasts. User growth is stagnant, with daily active users down 10% as TikTok and Meta dominate. In a recession, ad budgets shrink, and Snapchat's reliance on volatile ad revenue puts it first on the chopping block. These 30 companies are the tip of the iceberg, a warning of a deeper economic reckoning. Massive debt, shifting consumer priorities, and tariff-driven cost spikes are exposing cracks in America's corporate foundation. Tech, retail, automotive, and travel are all vulnerable, and a recession could turn these cracks into a full-blown collapse. This isn't just a corporate shakeout. It's a structural reset that could reshape the U.S. economy for decades. The question isn't if the crisis will hit, but how far it will spread and how deep the damage will be.